Albert Henry Wiggins was president and chairman of Chase National Bank. He had worked his way up from the bottom and made the smallish bank into a big one via a series of acquisitions. He was killing it. In 1928 and 1929, he was making $275,000 a year, which sounds pretty decent even without adjusting for 100 years of inflation. Obviously, then he had a front row seat to the stock market crash and Great Depression that followed. He did his best to reassure the markets as it was happening, saying, quote, "None of the corporations or institutions I am connected with is selling stocks at this time. We are, rather, buying." It didn't work though, obviously, and it wasn't even true. Later, he admitted that starting in September of 1929, several companies he operated on the side were shorting Chase stock. He wasn't just not buying, he was betting his own company's stock would collapse. Wiggin made $4 million on the trade. And the best part was, this was all completely legal.
There people have made the argument that insider trading should be legal. In fact, that would increase the chances that security prices accurately reflected their value if...
During something called the Pecora hearings that followed the stock market collapse, Wiggin was asked about his trading. He replied that he firmly believed that company officers should be allowed to speculate on their own stocks because it helped them develop a greater interest in their own institution. When pressed on whether this would mean that short selling your own stock means developing an interest that the institution would fail, he admitted maybe that wasn't the best idea. The Securities Act of 1933 and Securities Exchange Act of 1934 banned short selling by executives in their own company and placed the first ever real restrictions on insider trading, but not much was actually done about anything. An article I read summarized the situation saying, "The practice is so common and so difficult to detect that some people don't even believe it should be illegal. While the SEC can suspend stockbrokers, it does not have the power to bring criminal charges, and even when it wins in court, it can do nothing more than force those who traded illegally to cough up their improper profits and promise not to do it again." In other words, why wouldn't you insider trade? Because the worst thing that really was going to happen is you'd break even. Then John S.R. Shadd took over the SEC in 1981. He wanted to, quote, "come down on insider trading with hobnail boots." This is a hobnail boot. Between 1949 and 1981, there were a total of 22 insider trading cases brought by the SEC. From the time he was appointed to mid-1984, there were 55 more. He brought in John Fetters as his enforcement chief, who took the position that, quote, "put simply, it's nothing more than stealing by people in white shirts and suspenders." Fetters was a monster, 6'10", Marquette basketball player, so he even looked the part of someone who meant business. But first, some laws would have to change, and a series of cases in the 80s brought by these guys, first when they lost and later when they turned things around and started winning, eventually ushered in a time where insiders would at least have to think twice before taking advantage of their position. First, the losses. U.S. versus Chiarella. In this one, Vincent Chiarella, who worked in a printing shop that produced documents for Wall Street, started front-running the deals that he was printing the information for. The name of the companies involved was disguised on the documents when he received them, but he was smart enough to kind of put together all the context clues about the industry and the sizes of the deals. He knew who the real companies were. His case ended up in the Supreme Court, where they basically ruled that only true insiders can be guilty of insider trading violations. He didn't have a financial obligation to either of the companies on the sides of these mergers and acquisitions, so he didn't have to disclose anything that he knew prior to trading. Then there was SEC versus Dirks. A security analyst, Raymond L. Dirks, learns of fraud at Equity Funding Corp of America from somebody that worked there. He then warned his clients that they should sell everything before the news broke. In this one, the Supreme Court ruled that Dirks did not commit a violation, since the employee who had given him the information was not motivated by any financial or personal gain. Okay, but how could he not have had any sort of gain? The court bought the argument that the intent of the tip was to expose the fraud going on at the company, and that was ultimately what happened. The fraud company actually ends up going bankrupt. So that's good. And the fact that all these people made money on it just was kind of a bonus. Dirks, they said, couldn't be guilty of a violation because there was nothing improper about the information being released to him in the first place. But after those two losses, they started racking up some wins. The SEC versus Thayer, 1984, had to do with Paul Thayer, who led LTV Corp, which was basically a kind of defense contractor. He also sat on the boards of a variety of other public companies, and he just started tipping off all of his friends who were trading on it. This one is more notable for the who of involvement rather than the case itself being interesting. Thayer had just taken a post as the second highest ranking member of the Department of Defense, and going after him showed that the SEC was willing to go after anyone. Ultimately, he had to resign, and things were a little more spicy because it wasn't just the tips that made him look bad. The SEC couldn't nail him on receiving any financial gain from giving out these tips. Instead, they said you gained personally because among the people you were tipping was his mistress. So he made some personal gains there. Then there's U.S. versus Newman. James Newman of Morgan Stanley is charged in a criminal suit by a U.S. attorney because he's trading in shares of a takeover target that's getting represented by Morgan Stanley. This is a lot like the printing one that they lost earlier, except Newman isn't even having to do any special legwork to figure out the names of the companies because he just knows who they are. In this case, though, the tippers, including Newman, get convicted. There's a new important legal theory that's getting proposed in this one, and over a decade later, the Supreme Court eventually confirms it at the highest level. It has to do with something called misappropriation. Basically, if you take confidential information from anywhere, even if you don't have a direct fiduciary duty to the companies whose stock you trade in, you can't make money off it. When the Supreme Court made their big ruling on this, they made the analogy that this sort of tipping on info was like embezzlement, in that the owner of the confidential information has the exclusive use of the information, and the trader misappropriates that by trading on it and not disclosing the use of that to the owner of the information. So even though the Morgan Stanley guy didn't have a duty to the companies whose stock he traded in, he did have a duty to Morgan Stanley, and that's why what he did qualified as the insider trading. Finally, there is the SEC versus Winans. To some extent, kind of a Jim Cramer of his day, R. Foster Winans wrote a column for the Wall Street Journal called Heard on the Street. It was super popular and on occasion could move the market in a particular stock. This obviously meant that knowing what Winans was writing about and when those articles would drop was very valuable. Winans started giving this information out to select people and colleagues who over time earned substantial sums. This wasn't a sure thing like trading on a buyout, but the odds were stacked in your favor. The Winans case was unique because he didn't actually know anything about the companies besides what he learned in his own research from public information and maybe some phone calls with industry and management. Still, he had an employer, the Wall Street Journal, and he was misappropriating their exclusive right to the article he had written. Again, embezzling information. This is really similar to the kid who got in trouble for front-running the famous presentation by Bill Ackman on Herbalife. In theory, all the information being presented during the conference had already been public, but it was the existence of the presentation itself that was confidential. Ackman's fund can trade on the knowledge that they have a presentation coming out, since it's impossible to misappropriate from yourself. And I think that even the Wall Street Journal author, if instead he was writing a Substack or something, could have told all his friends that the article was about to come out and been fine. But I'm definitely not a lawyer. The only guarantee I can give you about when it's safe to insider trade is if you've been elected a member of Congress. Anyway, if this was good, please comment, because I think there might be more I can do on something called Regulation FD, which seemed awfully close to saying insider trading was legal, but you just had to manage a bunch of money professionally to do it, which obviously doesn't seem right, but that's for another time. Maybe. Thanks for watching, guys.